While the massive Wall Street mega banks are um, making global headlines and basically panicking over interest rate volatility.
Right, or freaking out over a commercial real estate cliff.
Exactly. While all that's happening, there's a quiet regional bank down in Georgia with a lotus flower logo of all things that is aggressively plotting to swallow up hundreds of its competitors.
Yeah, we spend so much time analyzing the titans of finance, the big household names,
Oh, constantly.
but we often become completely blind to the financial infrastructure operating right in our own backyards.
Have you ever looked at that brick-and-mortar regional bank branch on the corner of your town square and wondered how it actually survives against the global giants?
That's a great question.
Today, we are ripping apart the Q1 2026 investor presentation for Colony Bankcorp, Inc.
Yes, a very specific revealing source for this deep dive.
Right. Our goal is to decode this financial roadmap to show you how a regional bank balances 50-year-old local roots with, like, a ruthless, highly aggressive modernization playbook.
It's a really fascinating balance.
But, okay, let's unpack this, because I have to point out a truly surprising detail right from the very first slide of their pitch deck,
The logo.
their logo. It is a lotus flower.
Yeah, it's definitely different.
Honestly, if you just showed me the imagery without the corporate name, I would assume we were about to analyze the financials of a luxury wellness retreat in Sedona,
Right.
not a multi-billion-dollar financial institution.
I mean, it is a striking visual departure for an industry that historically leans heavily on, you know, imagery projecting impenetrable weight.
Iron shields, bald eagles.
Exactly. Massive granite columns. But the lotus flower is actually a highly deliberate psychological choice.
Really?
Yeah, the presentation notes it represents strength, resilience, and the potential for a new day.
Oh, wow.
And that sentiment tracks perfectly with their institutional timeline. I mean, Colony Bank started with a single vision in Fitzgerald, Georgia, back in 1975.
So they've been around a while.
They are currently reflecting on a 5-decade journey. They've weathered the stagflation of the late 70s, the dot-com bust, the 2008 financial crisis.
And the recent pandemic shocks, of course.
Exactly. So that survival isn't just based on good vibes, you know?
Right. 50 years means they have serious institutional muscle memory.
Definitely.
Surviving all those massive macroeconomic mood swings is a pretty high bar.
It is.
But survival is just treading water. Sure, a 50-year legacy is a nice story, but what do the numbers actually look like right now in 2026?
Well, when you actually look at their Q1 2026 numbers, they aren't just surviving to keep the lights on. They are sitting on $3.7 billion in assets.
$3.7 billion. How is a community bank generating that kind of immense capital velocity in today's wildly unpredictable economy?
The numbers in this Q1 report paint a picture of a very active, highly calibrated machine.
Okay, break that down for us.
So by the end of March 2026, Colony operates 37 locations across Georgia, plus a strategic footprint with 1 in Alabama and 5 down in Florida.
Nice regional spread.
Yeah. And for this single quarter, they reported an operating net income of $9.5 million.
That's just for the quarter.
Just for Q1. But the raw income figure isn't the most revealing metric here.
What is?
The true health of their financial engine is found in their net interest margin, or NIM.
Right, the IN. For anyone who doesn't spend their weekends reading bank balance sheets, this is basically the fundamental spread between what the bank earns in interest on the loans they issue and what they pay out in interest on the deposits sitting in checking and savings accounts.
Exactly. And their margin here is sitting at 3.48%.
Wait, 3.48%.
Yeah, and the deck highlights that this is their 6th consecutive quarter of expanding that margin.
Expanding it for 6 consecutive quarters? That seemingly defies gravity right now.
It really does.
Every financial headline we see is about banks getting completely crushed by the rising cost of keeping deposits. Like, everyone wants 5% on their savings.
Exactly. The deposit war is brutal right now.
Let's frame this. It's like running a lemonade stand where lemons keep getting more expensive, but you somehow keep increasing your profit per cup.
That's a great analogy.
Because it's less about selling an expensive product and more like having an unbreakable multi-year lease on your storefront for $500 a month, while all your competitors' rent just skyrocketed to $5,000.
Right, because their funding is so cheap, almost everything they make on loans goes straight to the bottom line.
So how are they doing that? How are they immune to the current squeeze?
What's fascinating here is that they aren't immune. They are insulated by the structure of their relationships.
Insulated how?
The secret is on the liability side of the ledger. Their cost of deposits is sitting at a microscopic 1.73%.
A 1.73% cost of deposits. In a market where consumers are aggressively chasing high-yield savings accounts,
Yep.
how do you convince anyone, let alone a business, to leave millions of dollars in an account earning almost nothing?
Well, you provide a service they cannot afford to interrupt.
Ah, I see.
Yeah, a massive chunk of their capital is sitting in non-interest-bearing accounts or very low-yield operational accounts.
So it's not just people's personal savings.
No, think about a mid-sized local business, say a commercial roofing company with 80 employees.
Um,
They need complex payroll processing, daily wire transfers, treasury management, and immediate access to working capital.
Right, heavy daily operations.
Exactly. If Colony Bank handles the daily plumbing of that business flawlessly and perhaps holds the mortgage on their warehouses.
The owner isn't going to suddenly rip out all their operational cash and move it to a faceless mega bank just to chase an extra 1.5% yield.
Precisely. The disruption to their daily business operations would cost far more than the interest they'd gain.
It's just not worth the headache.
No. And this is the underlying mechanism of sticky deposits. The relationship itself is the product, and it allows the bank to fund its own operations at a massive discount.
The stickiness of the relationship essentially acts as a subsidy for the bank's growth.
That's a perfect way to put it.
They've built an incredibly cheap, reliable funding engine. But squeezing out better margins on existing business has a ceiling, right?
Oh, absolutely.
When we look at their stated long-term objectives, they are targeting 8 to 12% annual growth in their customer base.
Which is very ambitious.
Yeah, you simply cannot rely on organic word-of-mouth growth to hit double digits year after year.
Right.
You have to go shopping.
You do. Organic growth in dynamic, expanding markets like Atlanta, Jacksonville, and Savannah is certainly part of the formula. But scaling a regional bank to the next tier requires mergers and acquisitions to be the primary lever.
Here's where it gets really interesting. When I read through the M&A strategy section of this deck, it genuinely reads like a game of corporate Pac-Man.
Corporate Pac-Man, I like that.
They are not waiting for the phone to ring. They have mapped out the entire board.
They have. The presentation explicitly declares their intent to become the acquirer of choice across Georgia and its contiguous states.
To use those exact words, acquirer of choice.
Yes. And they have identified a massive, highly specific target pool. The radar includes 358 banks operating with under $1 billion in assets.
Wow.
And another 76 banks sitting in the $1 billion to $2.5 billion range.
Over 400 potential acquisition targets.
It's a huge landscape.
And this is why this matters deeply to you, the listener. If you live in the Southeast and you do your banking at a small, single-town institution, there is a very high statistical probability your bank is sitting on Colony's internal target list.
Very likely, yeah.
Consolidation is not an abstract concept confined to Wall Street skyscrapers, right? It is literally reshaping the financial map of your local county.
It's happening in your backyard.
But why would all these independent banks want to sell?
Well, it is a crushing combination of demographics and regulatory reality.
Okay, paint a picture for us.
Picture a small, family-owned bank founded in the 1980s.
Right.
The current leadership is nearing retirement age, and the next generation has no interest in running a highly regulated financial institution.
That makes sense.
Simultaneously, new federal cybersecurity mandates, compliance requirements, and the sheer cost of upgrading consumer-facing technology require millions of dollars in capital investment.
Which they just don't have.
Exactly. A bank with only $400 million in assets simply cannot absorb those costs without destroying their profit margins.
But Colony can.
Yes. Colony, sitting at $3.7 billion, has already built the compliance and technological infrastructure.
Right.
They can absorb that smaller bank, strip out the duplicate back-office costs, and immediately make that acquired branch more profitable.
I see the financial logic. But that brings up a massive operational red flag for me.
What's that?
Well, if their primary growth engine involves gobbling up hundreds of legacy banks, aren't they just inheriting a mountain of outdated, fragmented 1990s technology?
That is a very real concern.
Every time they buy a bank, they are essentially buying a messy physical server room and a staff used to doing things on paper. It sounds like a recipe for a sluggish, bloated bureaucracy.
And that is the exact trap that destroys poorly executed M&A strategies. The acquiring bank gets crushed under the weight of integrating obsolete systems.
So how do they avoid that?
Colony addresses this head-on with a parallel initiative they title Efficiency and Scaling. They recently brought in a director of optimization.
Director of Optimization is a very intense title.
It is, and they recruited talent specifically with experience from much larger regional institutions to fill it.
But what is that person actually doing on a Tuesday morning to prevent this tech bloat?
They are deploying robotic process automation, or RPA,
Yeah.
alongside targeted AI integration.
Hold on. Let's translate that. What does robotic process automation actually do inside a bank? Are we talking about physical robots moving cash around a vault?
No, not physical robots, software bots.
Okay, got it.
Think of RPA as a tireless digital assistant capable of executing high-volume, repetitive tasks across multiple computer systems.
So data entry, basically.
Yeah, exactly. When Colony acquires a smaller bank, they suddenly have thousands of new commercial loan documents, customer profiles, and compliance checks that need to be migrated into their master system.
That sounds like a nightmare.
Historically, it was. It required an army of human administrators manually typing data from one screen to another for months.
But with RPA?
With RPA, a software bot can scan, read, verify, and input tens of thousands of documents overnight.
Overnight. That's incredible.
Yes, flagging only the anomalies for human review. It turns a massive, costly integration headache into a scalable, automated process.
Oh, I see.
They gain the new customers without proportionally increasing their payroll.
So they are aggressive about not building this infrastructure from scratch either.
Right.
Because they note investments in fintech funds and partnerships with emerging technology firms. They want the digital convenience of a Chase or a Bank of America on the back end, while maintaining the illusion of the small-town bank on the front end.
That's the sweet spot they're aiming for.
But modernizing isn't just about updating the software, is it? It is about completely changing the products they sell. Which brings us to what I like to call their corporate side hustles.
Yes, the side hustles. It is a profound shift in banking strategy. The presentation outlines a specific short-term objective.
What's the goal?
To establish 5 complementary lines of business, each independently earning over $1 million in net income.
The breakdown of these complementary lines is just wild. It goes way beyond writing traditional 30-year mortgages or commercial real estate loans.
Way beyond.
I was staring at these specific, highly niche revenue streams in the source. For example, marine and RV lending.
Oh, yeah.
In the first quarter of 2026 alone, financing boats and RVs brought in $459,000 in pre-tax profit.
Almost $500,000.
Nearly $500,000 in 90 days just from recreational vehicles. Why are they so successful in a space that seems incredibly risky? I mean, if the economy dips, the first thing people default on is the luxury boat.
And that is exactly what a Wall Street algorithm would dictate, flagging recreational vehicles as highly discretionary and dangerous during economic uncertainty.
Right. So why are they leaning into it?
Because regional lending operates on granular local knowledge. A community bank understands the local geography.
How so?
They know the massive RV dealerships down in the Florida Panhandle. They understand the specific buyer demographics in Savannah.
Oh, I get it. It's about personal relationships.
Exactly. Because they have personal relationships with the dealers and a deep understanding of local collateral values, they can price that risk with far more accuracy than a distant megabank relying purely on a national credit score model.
So they are exploiting the blind spots of the national models.
Spot on.
And the diversification doesn't stop at RVs. They run a small business specialty lending group. They operate an entire wealth management division under Colony Financial Advisors.
Which is huge, by the way.
Yeah. The deck says it has ballooned to $555 million in assets under management.
For over $500 million.
And they have an insurance division sitting on $34.2 million in premiums in force.
If we connect this to the bigger picture, it fundamentally redefines the architecture of a regional bank.
How so?
The old model of simply taking in local deposits to fund local mortgages is dead. Today, an institution must be a financial Swiss Army knife.
A Swiss Army knife. I like that.
If a commercial client gets a loan for their new manufacturing facility, Colony wants to write the commercial insurance policy for that building.
Right.
And then handle the payroll processing for the employees and eventually manage the personal retirement portfolio of the CEO.
It creates an ecosystem the customer never needs to leave.
Exactly.
And I imagine those specific divisions like insurance and wealth management are crucial because they generate non-interest fee income.
Yes, that's key.
They aren't tied to the whims of the Federal Reserve raising or lowering interest rates. If the net interest margin gets squeezed, Those management fees act as a massive stabilizing force on the balance sheet.
It is the ultimate hedge against monetary policy volatility.
So what does this all mean? We have decoded this incredibly diverse, aggressive institution.
We have.
They are financing luxury boats, they are systematically hunting down hundreds of smaller banks for acquisition, they are deploying software bots to read loan documents, and they manage over $500 million in private wealth.
That's quite the resume.
All of this growth sounds phenomenal on a PowerPoint slide, but the last few years have brutally demonstrated that banks can fail terrifyingly quickly.
Oh, absolutely.
We have seen institutions evaporate over a weekend because of a sudden run on deposits. How solid is the actual foundation underneath all this growth? What happens if the local economy takes a sudden, severe hit?
Well, liquidity and risk management are the ultimate litmus tests for any bank's survival.
Right.
And Colony's leadership dedicates significant presentation real estate to detailing what they classify as fortress liquidity.
Fortress liquidity. That sounds reassuring, but what does it mean?
They maintain a highly defensive, deeply entrenched posture. As of Q1 2026, their total liquidity sources sit at $1.85 billion.
Almost $2 billion just standing by.
Yep.
But hold on, translate the mechanics of that for a second. That $1.85 billion isn't literally stacked in a giant vault in Fitzgerald, Georgia.
Definitely not.
The deck mentions unencumbered securities and borrowing capacity with the FHLB. Break down that banking jargon.
Yeah.
Are these just treasury bonds sitting in an account somewhere?
Essentially, yes, combined with guaranteed credit lines.
Okay.
Unencumbered securities means the bank owns incredibly safe assets like U.S. Treasury bonds or highly rated municipal bonds, free and clear.
Meaning no one else has a claim on them.
Right. No other entity has a claim on them. If a panic were to strike on a random Tuesday morning and depositors demanded their cash, Colony doesn't have to desperately sell off their long-term commercial loans at a massive loss to raise funds.
Because selling at a loss is what kills the bank.
Exactly. Instead, they can instantly pledge those unencumbered securities to the Federal Home Loan Bank, the FHLB.
Which does what?
It acts as a reliable lender of last resort for community institutions. They hand over the safe bonds as collateral. The FHLB wires them hundreds of millions in hard cash instantly, and they hand that cash to the depositors.
Wow, it's just like that.
Just like that. The panic is stopped before it can even gather momentum.
But obviously, the absolute best defense against a bank run is ensuring your depositors never feel the need to panic in the first place.
Which brings us to the psychology of their depositor base.
Let's talk about that. Who is actually keeping their money there?
When you analyze the sheer volume of accounts at Colony, 84.9% belong to everyday consumers.
Just regular retail checking and savings accounts.
Right. But when you weigh the actual capital, the physical dollars inside the bank, over 42% of the deposit balances are driven by commercial and business clients.
So the businesses are holding a massive amount of the real weight of the bank's funding.
They are.
But isn't that inherently dangerous? If a specific industry experiences a severe downturn, those businesses burn through their cash, pull their deposits to survive, and the bank is suddenly drained of its lifeblood.
Well, you have just described the exact vulnerability that caused the catastrophic bank failures of 2023.
Oh, right.
Those institutions were fatally tied to a single monolithic sector, specifically tech startups and venture capital.
So when the tech sector contracted, every single client needed their money at the exact same time.
Precisely. But Colony avoids this through aggressive diversification, which is proven out by their NAICS code breakdown in the deck.
Let's define that real quick. NAICS is simply the classification system the government uses to categorize different types of businesses.
Yes.
Think of those NAICS codes as the bank's immune system.
Right.
Let's look at the actual pie chart in the deck because it is incredibly fragmented.
It really is beautifully scattered.
Public administration accounts for 16%. Finance and insurance make up 16.3%. Construction sits at 12.7%. You also have massive tranches of educational services, healthcare, manufacturing, and retail.
It is the ultimate financial shock absorber.
Yeah.
The fundamental flaw of the banks that failed in 2023 was that their clients all shared the same group chats and social media networks.
Oh, that's such a good point.
When a panic started on Twitter, they all withdrew funds simultaneously.
But Colony's money is coming from the local school district, the neighborhood paving company, and the regional hospital system.
Exactly. They don't share a group chat.
Right. The paving contractor isn't panic withdrawing millions because a software startup in Silicon Valley missed an earnings call.
Never gonna happen.
If the commercial real estate market softens or residential construction halts, The bank doesn't topple because the school districts are still receiving tax revenue, the hospitals are still processing insurance claims, and the retail shops are still running daily transactions.
The diversity prevents local economic pain from becoming a systemic institutional crisis.
It stops financial contagion dead in its tracks.
It is the fundamental principle of diversification applied not just to investments, but to the very source of the institution's lifeblood.
So we started this deep dive looking at a local bank founded during the Ford administration, hiding behind a lotus flower logo.
Seems so long ago now.
It does. And what we uncovered beneath that calm branding is a highly sophisticated, aggressively modern financial machine.
Truly.
They are utilizing software bots to digest the hundreds of legacy banks they are systematically targeting across the Southeast. They are financing luxury recreational vehicles through deep local networks.
They're managing over $500 million in private wealth.
Yes. And engineering a brilliantly boring, hyper-diverse commercial deposit base to ensure their multi-billion-dollar fortress remains completely unshakable.
It really is a masterclass in operational adaptation. They have realized that nostalgia does not pay dividends.
No, it doesn't.
But looking at the sheer scale of their technological integration, it raises a deeply provocative question regarding the future trajectory of the entire banking industry.
Oh, I love these macro questions. What are you seeing?
Well, we just detailed how Colony is aggressively adopting the exact same artificial intelligence tools, the same robotic process automation, and the same fintech backbones as the massive Wall Street titans.
Right, they're optimizing away all the friction.
Exactly. But as this technology inevitably levels the playing field, making the operational backend of a local bank identical to a global megabank, what happens to the traditional value proposition?
Oh, that's interesting.
Does having a human being who actually knows your business model and your family's history become the ultimate luxury, like a premium product in a sea of algorithms?
Wow.
Or, as every aspect of our financial lives migrates to the screens in our pockets, will the distinction between a community bank and a national bank simply evaporate entirely?
When the AI is identical across the board, the human relationship becomes the sole differentiator. Are you willing to pay a premium or accept a lower yield just to have a real person pick up the phone when something goes wrong?
It's the ultimate question.
That is a fascinating lens to view the future through. We will leave you with that thought to ponder.
Thanks for having me.
The next time you drive past that quiet brick branch in your hometown, remember, there's a massive, incredibly complex game of corporate strategy happening right behind those doors. Keep questioning the systems around you, and thanks for joining us on this deep dive.